Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Wantrobski, Technical Strategist and Associate Director of Research with Janney, Montgomery. Scott, Dan, it's great to have you with us. Welcome to Trade Talks.
Oh, thanks for having me.
All right, let's talk about U.S. equities here and where we are in this cycle. How far do you think we are in this bull run?
Well, look, from our metrics, we think we're about 7 or 8 years old. I know that seems like a long time, but if you look at the cadence of prior secular expansion periods here in the U.S., they really last anywhere from 10 to 15 years on average. I think this bull market started sometime around 2012, 2013. That's really when we broke out to new all-time highs and benchmarks like the S&P 500, the Dow, even the Russell 2000. So based on those historical data points, we think we have a few more years to travel. We think actually the S&P 500, which is trading just shy of 4,500 today, we actually think it's going to eclipse 5,000 in the next 1 to 2 years or so.
And what are the key drivers for the cycle that we're in right now?
Yeah, they're important ones, and they're really not talked about all that often. I mean, the first one is obviously liquidity. We know that's talked about quite a bit. And if you look at secular bull markets in the past for the U.S., liquidity conditions have always been accommodative in our biggest bull market cycles. This is everything from the 1982 to 2000 bull market, even the bull market from the 40s, 50s, and 1960s. So one of the drivers is always going to be liquidity. And as we know, the Fed remains extremely accommodative to the liquidity cycle this time around. We know there are fears of taper ahead, but remember, taper and tightening are two sort of different things. They're going to take their foot off the gas pedal a little bit, but they are still going to remain largely accommodative on a liquidity front. The second driver is very important here, I think, especially to the U.S., and that's really demographics. People focus on an aging global population, but in the not too distant future, U.S. demographics actually look pretty healthy. Now, we talk about the aging baby boomers sort of moving out of the system as they move towards retirement. They're about 82 million strong, but realize that behind them you have Generation X, Gen X at 50 million, the millennials at 95 million, and then rising behind them is Gen Z at about 80 million. These three younger populations, I believe, are going to more than offset that productivity, that consumptive activity that we lose in the baby boomers in the years ahead. So you have liquidity, you have a healthy demographic profile, not forever, but for the next several years. And I think those two things are going to continue to grow the economy at a moderate pace, and they're going to continue to push up the market multiple. That's why we have this target north of 5,000 in the coming years for the S&P 500.
Now, stocks are trading at lofty valuations in the near term. Are you expecting a correction to bring valuations back in line? And what would be the drivers of any short-term volatility?
Yeah, no, it's a great question. And, so many people are looking at the same things, right? So stocks clearly are not cheap here. But the question is are they at their peak multiple? Are they at the peak of this cycle? And when we look at history, and we look at history relative to the money supply, and that's a key metric going forward, we think there's room for multiple expansion in the years ahead. Remember that the Fed has literally expanded our money supply exponentially over the past 12 months. We actually think it's set up a situation of too much money chasing too few stocks. So even though stocks are expensive on a short-term basis, any corrective activity that we see, whether it's a 10% correction, a 15% correction, which would be a deep bear pocket, that's going to lower that multiple. So yes, we are looking for a correction. Many people are looking for a correction. I think it would be in the realm of about 10 to 15%. To put that in perspective, 10% hit on the S&P 500 gets us down to about 4,000, maybe even sub 4,000. That would be over the short run. That would go a long way to reducing that froth in valuation. In terms of what are the disruptors to cause this, look, we're all talking about the same things. You have Fed policy as the number one, right? If they taper, if there's any significant changes there, that could trigger a correction. Watch the pandemic as well. We know the Delta variant. We know schools are coming up, whether they close, whether local economies decide to stay open, reopen, move forward, or sort of pull back. That could cause a dislocation in the markets. You also want to look at administrative risks, so what the federal government is doing, either in terms of fiscal stimulus, geopolitical policy overseas, any new regulation risks, taxes, regulations on different industries. Those could be short-term disruptors that trigger a market correction. And then the final one is watch interest rates in this market. Interest rates very important in this bull market cycle right now. If you have volatility in the bond markets, I think that can cross over into equities, trigger correction. Again, anywhere 8 to 10% correction, I think over the next couple of months, especially August, October timeframe, could be a little bit more to shake some things out. We do not think that's going to lead to the end of this bull market cycle, though. All
right, Dan, and to wrap up here, what sectors do you expect to outperform with this backdrop?
Yeah, look, if we get the correction and we look to move in terms of sideline money, again, we're watching interest rates very closely. I think this is a reflationary bull market cycle. It means the 10-year, I believe, is going to trade, north of 2%, not over the short run, but in the next 1 to 2 years, 2.5%. That's going to help to determine which sectors start to outperform. So you look at the correlation, you look at the relationships between interest rates and different sectors. It's gonna point out, value stocks. Value can act a lot better in a rising rate environment. Cyclicals, small caps and mid caps, even banks, financials. If you look, those groups that I just mentioned, they've all been underperformers for a good chunk of this year as the 10-year Treasury yield has drifted lower. Once that 10-year Treasury starts to move higher again, and again, our call is for this to move towards 2.5%, I think those sectors will look a lot better. So again, banks, financials, value stocks, cyclicals, even small mid caps in this next cycle.
All right, Dan, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.